Thanks so much. To those of you who are in the audience, thanks for taking your time. What I want you to do is take one thing away from this talk, in that there is no typical bridge loan. So what you'll find out is that they take many shapes and sizes. They're structured in a variety of ways. But at the end of the day, to understand a bridge loan is to think, okay, I'm getting something. You're getting a company between point A and point B. And it's the capital, it's the necessary working capital to get the company from A to B. So what I'm going to do is talk through the various aspects of a bridge loan, just to some presentation ground rules. I prefer this not be a monologue, make it a dialogue. If you have questions, feel free to reach out. I'm going to be throwing a bunch of information at you, so please just try and bear with it. And then there'll be plenty of time to ask questions at the end. And by the way, there are no dumb questions. So let's go from there as ground rules. As Emily mentioned, I've been running Agility for the last 23 years now. I've been in the venture lending space for about 25. I've got accolades of numbers of financings and dollars lent, but just consider it an idea that I've got a background in it. You can call me an expert, but there's plenty of us out there. So seek others as for that advice. I've got background in both venture lending, but also in angel investing. I've helped start 2 different angel groups in the Central Coast area of California. One was the Central Coast chapter of the Tech Coast Angels a number of years back, and then a founding member of the Santa Barbara Angel Alliance. So active angel investor as well. And again, enjoy the art of investing. How's that? So Agility, what do? We're a lender. So we manage a pool of capital. We raised a fund, much like a venture fund, a $10 million fund. But instead of deploying that capital as equity, which equity investors do, we're a lender. So for each dollar that we loan, these are short-term loans. Think about them, maybe they're 6 months long or 12 months long. For every loan that we make, we have the ability to recycle that capital. So we'll put $1 out or $1 million out, and it'll come back in 9 months. We're able to take that $1 million and re-lend it. So we're constantly turning over that capital. And so that's what we call an evergreen structure. The focus on the companies that we're financing are emerging growth companies. So these are typically some sort of technology, and sometimes they've raised outside capital, whether it's venture capital or angel investing, or they've bootstrapped themselves, and so they're just trying to figure out how to make it on their own. The loan sizes for our fund are relatively small when you compare them to many other lenders. So our loan sizes are $300,000 to maybe $2 million at the top end. And when you think about that, what we're doing is we're covering the operating expenses of these companies, or otherwise known as their burn rate. So from that perspective, we're making smaller loans, and therefore we like companies with small burn rates. That's the operating losses, if you're not familiar. The way we deploy our capital, we are a senior lender, and I'll get into how we secure our loans. Sometimes we're subordinate to a bank's accounts receivable line of credit, but most of the time we're the senior lender. We are the bank for that matter. And then the typical borrower has 3 things, and I'll probably beat this into your head a little bit too much, but what we like to find are companies that have products, customers, and revenue. Those 3 things give us the understanding that there's the possibility to be repaid. So at the end of the day, we're a lender. We like to get our capital back. We're not an equity investor. And so those 3 things give us the ability to help get over the hump to think that, okay, this company can repay our loan. So what we like to see in a revenue standpoint is that their revenues are greater than 2 million trailing 12-month revenues. So you have an understanding of what the magnitude is of the types of companies that we'll fund. So in general, what is a bridge loan? At the end of the day, a bridge loan is a short-term loan, and its typical length of time, its maturity is anywhere from, it can be as short as 2 or 3 months, but it's typically 6 months to 24 months. Anything beyond 24 months is not necessarily considered short-term. And at the end of the day, if you can walk away with anything from this talk, you'll say that, okay, a bridge loan is something, it's a financing vehicle that will get a company between point A and point B. So that's basically what a bridge loan is. It can be getting a company from a seed round of equity to a Series A to Series B. It can be something to get a company from cash burn to cash flow. We can actually bridge a company to an acquisition. But at the end of the day, it's intended to bridge the financing gap that the company experiences, because these are not profitable companies. These are companies that are burning cash. And what they need is this short-term vehicle to get them to a point where then they are going to execute on some event. That event might be an equity raise. It might be, again, an acquisition or getting to cash flow positive. There's a variety of structures, and I'll get into that, whether it's convertible debt or it's conventional debt. And then the instrument itself is, the focus is what the event is that we're bridging to. Again, are we bridging to an equity raise or an M&A transaction or something along those lines? In certain instances, the loan will convert from debt to equity. To me, again, that's a convertible note. And I'll get into this in a bit. The difference, the two different elements here are it's either a convertible loan, convertible debt, it converts from debt to equity, or it gets paid off. And so what we deal with are loans that get paid off, get repaid. And so from that perspective, we're a true lender. We're not an equity investor with the expectation that this loan converts to equity. So at the end of the day, the bridge loan provider could be anyone. It could be an insider, it could be an equity investor, it could be a board member, someone very familiar with the company, it could be a parent, it could be an uncle, it could be a strategic partner. Maybe it's say one of your vendors, or maybe it's one of your customers, or potentially an acquisition partner, or it could be a third-party lender like ourselves, or maybe even a bank, although banks are hesitant to provide bridge loans. So why would a company seek out a bridge loan? At the end of the day, again, if you can walk away with anything today, it's an extension of runway. Literally, it gives company time to execute on what they're trying to get to, and it gives them the adequate working capital to get there. So oftentimes, a loan can be less costly to put together than to raise equity in order to get to an M&A transaction. And they don't want, a company may know that they're going to get acquired, and they just don't want to go out and raise equity because they're short on cash. So what they can do is they can borrow money and get to that event. Again, another reason why companies seeking bridge loans is that it's oftentimes bridging to a more conventional lending facility. So let's say the company hasn't reached cash flow neutrality, or they haven't gotten to profitability, and they're trying to get there. We can bridge them to a loan that a bank might make. And then there's a variety of reasons here. One of the reasons might be that it's, the company wants to kick the can down the road and not value the company today, because they know that the valuation is going to be hampered or impacted because of today's economic situation. And they want to value it in a year from now, when maybe they've made more sales, or they've had further intellectual property development, or other tangible value that the company's generated, and they can value the company at that time. And then for other reasons, if an insider would be providing the bridge loan, sometimes they're a board member and there's conflicts among the board, and so they themselves can't make that loan. So they'll look to someone like ourselves, a third party, to make the loan for them. Sometimes the company has bootstrapped itself and it's trying to get to that seed round or that Series A, and they're looking for some kind of institutional money. Now, we use air quotes for that, but we're not necessarily an institution, but we're an institute. We're like an institution and an institutional investor. So I'm going to do some comparison between what I consider a convertible loan, convertible bridge loan, convertible debt versus a straight bridge loan. We are a straight bridge lender, so we are a lender. We're not an equity investor. At the end of the day, an insider or an investor in a company would be providing a bridge loan in a convertible debt scenario. At the end of the day, and again, if you can remember a couple of things from this talk, convertible debt is literally it's equity disguised as debt. It's the idea here is that they're interested in buying equity, but they're using debt as the vehicle to get there because the company isn't quite ready for an equity raise. Whereas when you compare it to a straight debt, the convertible debt is going to turn into equity. It's going to convert to equity that the company will own. Whoever's providing the bridge loan will own stock in the company. For us, we're straight debt. We're not going to convert. We're much like a bank, and we're a non-bank lender, but we're going to get repaid at the end or at the maturity of that loan. So they're two completely separate and disparate ideas. So just try and remember that convertible debt is equity. Straight debt is a loan, much like a student loan or a car loan, things like that. They need to be repaid. So the sources is obvious, the insiders or other existing investors or interested investors would provide a convertible debt piece. A straight debt is a bank or a non-bank lender like ourselves. Security interest, typically the convertible debt is unsecured. And I'm going to get into what security means in a minute, but just suffice it to say for now, a senior lender, when we are a straight debt lender, we take a full security interest in the assets of the company that we're lending to. Whereas a conventional where a convertible debt will not. In a convertible debt scenario, the loan and interest converts into equity, like I just said. In a straight debt, the loan is repaid to the lender. And again, it's typically upon achieving this next equity round. For the convertible debt, the interest, it accrues. So it just gets added to the loan itself. And then that will convert interest, and the principal will actually convert into equity. For a straight debt, the interest is paid monthly. So we're paid on a monthly basis the interest that we're charging. And I'll get into how we charge that. But again, these are two completely separate entities or instruments, and kind of just get it through your head that convertible debt is equity, straight debt is a loan. And then covenants, I'll describe what covenants are in a minute. Typically, there are no covenants in a convertible debt instrument. In a straight debt instrument, like what we provide, there are covenants, and oftentimes there are operational or liquidity covenants. I'll describe those in a minute. And the timing can be done in a couple of days for a convertible debt piece. A safe, which is oftentimes it's a secured instrument for further equity financing. These things can be downloaded from the internet. You can type in information and make it available literally in minutes. But suffice it to say that a convertible debt piece is usually much cleaner, much more straightforward than an equity raise. And again, it can be done in a matter of days, versus a straight debt can typically take 2 to 4 weeks. We've made loans in 5 business days. So it gives you a feel for how quickly we can operate. But again, typically the timing is a couple of weeks. It's still much, much faster than raising equity. Let's put it that way. I'm going to continue on comparing these two, convertible debt versus straight debt. The use of the capital, they're both the same. It's for working capital. It's to cover the burn rate of the company while the company operates to try and achieve that next milestone. On a convertible debt, it's truly equity. Again, it converts into the next round. There might be what we would call sweeteners or enhancements that the investor gets or they receive for coming in as a debt instrument and as a convertible debt piece. And that might be a discount to the strike price of the equity that the upcoming round would be priced at, or they may end up getting warrants, or they may get both of those. On the straight debt side, the only equity that the lender receives is what's known as a warrant. And so a warrant is basically an option to buy stock. It's much like a employee stock option. It gives the lender the option or the right, but not the obligation to buy stock at a later date. And a warrant can have a good sized life. So it can have 5 to 10 years. Typically they're 7 years in term. And what it does is it acts as a sweetener to us lenders who are taking a risk and lending to a company that's got a burn rate. And what we're able to do is get an option to buy stock at today's price or at the next round price. And it gives us the ability to buy stock at some point in the future, but at today's price. So if the company does very, very well, and today's price is $1 a share, and they have an IPO at $12 a share, we can buy the stock at the $12 time frame, but buy it for $1. So we get a very nice return when the warrants are provided to us. And then the great thing about all these is that there's no valuation issues. At the time of any loan being made to the company, we're not having to do any kind of valuation exercises, whereas an equity investor will look at the market and say, oh, your company's worth 22 million or 5 million or 150 million. When we're making these loans, we're not making any valuation judgments or decisions. We're just simply taking the price per share at that upcoming round. And then finally, we do, when there's default provisions, if the company defaults on the loan, the default provision under a convertible debt is that the loan needs to be repaid. At the end of the day, if you think about it, if the company defaults on the loan and let's say they can't repay it, that means they've run out of money. Repayment is not an option. So in reality, it's a convertible debt piece is truly an equity investment. That's the intent. Under straight debt, we have default provisions. Again, I've described covenants a little earlier. A covenant is if you would, they are guardrails that the company needs to operate under. There are certain provisions, whether they be revenue guidelines or minimum cash in the bank or burn rates that the company needs to operate by, that the lender can monitor and make sure that the company's operating within those guidelines. If the company operates outside those guidelines, the lender can call the loan and say, you need to repay our loan. So those are the default provisions. We also have something called a MAC clause. So this is something, again, if you can walk away with this is important. This is what's known as a material adverse change. So if the company experiences something radically bad, i.e. they had all of their customers pull the plug and are no longer customers, or three of the management team, CEO and CFO and CMO leave, those would be considered a material adverse change. And so from our perspective, if something quote unquote really bad like that happens, we have the ability to call the loan. Under a convertible debt, there is no MAC clause. So there's no ability for the lender to be able to call that loan. And then under these days, it's a tough equity raise environment. A liquidation preference is often put into the loans that a convertible debt piece would be structured under. So the liquidation preference often is 2 times or 3 times the loan amount. So let's say during the time that the company has this convertible debt piece, this bridge loan, if the company gets acquired, the lender gets 2 to 3 times their money repaid before anyone else gets another penny. So that's what's called a liquidation preference. On straight debt loans, there are no liquidation preferences, but we might get what's called a put right. We might have the ability to put our warrant back to the company for some buyout fee or some dollar amount. But again, there's no upside, so to speak, for a straight debt lender in the liquidation unless the warrants are what's known as in the money. So things that we look for in companies, if they've raised outside capital, that's fine, from friends and family or from angels or investors, institutional investors. It's not critical. What we like to see, as I mentioned before, are the 3 things: the products, customers, and the revenue. And again, we want to see revenues in the trailing 12-month revenues of maybe 2 million or more. Again, that proves to us that the company has some operating potential. What we like to say is that the dogs are eating the dog food and they're willing to pay for it. We want to make sure that there's a good, solid management team. They've got the background to be able to execute on the opportunity that's ahead of them. And we are typically focused on business-to-business type investments, but again, we've done some consumer packaged goods and others, so we're not strictly held to that. We like to see that the company has a substantial board of directors and very solid and if you would, impressive, name recognized, and that they've got other advisors that are advising the company, simply because, again, entrepreneurs doing things on their own in a vacuum oftentimes can lead themselves down rabbit holes that are not a benefit to the investor. And then again, what we're looking for companies that have exceptional growth capabilities and prospects. Our focus is the Western US. There are lenders who will lend across the United States and do it internationally, but we just like companies that are kind of San Diego to Seattle and east to Colorado. Call us lazy, but that's what we like. And then what we like best, and we ask the management team, what's their plan A? Their plan A is to raise equity to pay us off. Well, what's plan B? What's plan C? What's plan D if plan A doesn't happen? And what we want to see is that entrepreneur has thought this through, that if we can't raise that equity, then we can get to cash flow neutrality by doing X, Y, and Z. And then over time, we can pay you off with the profits of our business. And then what's plan C? Well, we will sell our company to one of our competitors or a strategic partner. And what's plan D? So what we like to do is make sure that these companies have really thought through all the different options and to be able to repay our loan. And then I mentioned earlier how we secure our loans. Since we're a senior lender, we are securing the interests of our loan with the assets of the company. So we're at what's known as the top of the capital stack, meaning if the company is acquired or there's any kind of liquidation, we are paid first. We're paid down until our loan is repaid, and then the rest of the money will go to usually unsecured creditors like your vendors, and then finally the equity investors. So to do this, what we do is we file what's called a UCC1, or a Uniform Commercial Code number 1 document, which puts our name on the operations of the company. Basically, if you go to the Secretary of State and you look up the operations of a company, you will see if there are any liens on the assets of the company. And so with that, what that means is that we are the first to be repaid if anything is going to go down with the company. And it's a very easy search to be done. Typically, all investors, equity investors, will do a UCC search to see if there's any liens against the assets of the company. And if there are, then they determine, okay, how much does it cost to repay that loan in order to take that lien off. It's like a lien on a car. If you owe money on a car, someone else holds title to the car. We're actually holding title to the company, for the lack of a better term. And we will file a security interest with the Patent and Trademark Office on any copyrights or any patents and any trademarks. And so it puts the company on notice, it puts any investors on notice that we are the senior lender, that any other funds that would come into the company, we have the right to pay our loan down. A DACA is an instrument with any bank that tells the bank that in the case of an event of default, we have the right to acquire or get the cash that the company is deposited in their bank. We'll even go to the point of notifying the insurance provider to the company that we're a loss payable endorsee, to the point where if something happens to the company and there's going to be an insurance payout, we're the first to be paid before anyone else is paid. So then when we underwrite the loans, we're interviewing the management team, we're interviewing key customers, and then we're making sure that any existing loans are subordinate or not repaid before we're repaid. So if there's any insiders, any investors that have made loans to the companies, then we make them sign a document that says, I will not be repaid before you're repaid. I talked about the material adverse change clause a little earlier. If something really bad goes on with the company, we have the ability to call the loan and get it repaid. And then we have these operational covenants. And like I said, those are guidelines. Those are, if you would, they're operational guideposts for the company that it needs to operate under in order for us to be comfortable as a lender. So typical pricing of a loan is we have an interest rate, and then we have some kind of fee, and then we get our warrant, as I described earlier. So the interest rates in today's market, they're in the mid-teens. Bank interest rates are in the 8 to 9%. So it gives you an understanding that we're a bit more expensive than a bank. The loan origination fee, basically, it recoups the cost of us to put the loan in place. It takes a bunch of time and a bunch of effort. And so this basically covers our expense and brain damage to put this loan in place. And so that's 2% to 5% of the overall loan amount. So if it's a $1 million loan, that'd be a $20,000 fee that's paid at closing. And then the warrant gives us that option to buy stock at a later date based on today's price. And that warrant at the end of the day, what we want is somewhere between 0.5% to maybe 2% of the fully diluted shares of our borrower. So usually an equity investor will get between 10 and 30% of the equity of the company, depending upon how much they're going to put in and how much of the equity that they're buying. So at the end of the day, we are dilutive. We're minutely dilutive in comparison to, say, equity. And so again, we're looking at 0.5% to maybe 2% of the fully diluted shares. And then the way we structure loans is in a variety of ways. There can be a single draw. Let's say it's a $500,000 loan, and here's a bullet. Here's $500,000 loan. Here's $500,000. Pay us at maturity, and that's it. They use that capital to operate on. When they execute on whatever they're trying to get to, they repay our loan. They pay interest on a monthly basis, but again, that capital is just deployed at closing, and the borrower is able to use that capital as they see fit. There's multi-tranche loans where what we'll do is we'll deploy capital based on milestones. So let's say $1 million loan we make to a company, we might put $500,000 out at the initial tranche of capital when we close the loan. And then we'll have, let's say, a $250,000 tranche when the company achieves a term sheet from an equity investor, or if they're looking to be acquired, there might be a letter of intent or something along those lines that we can look at and say, okay, they've achieved that milestone. here, we're going to deploy more capital. And then finally, there might be a final tranche once let's say the definitive documents become circulating for either that equity investment or that M&A transaction. We might do an asset-based lending facility whereby we're lending based on the accounts receivable plus inventory, or just the accounts receivable of the borrower. And therefore, we're giving them the ability to leverage an asset on their balance sheet that they'd otherwise not be able to. There's other forms, there's other structures, I won't get into them, but there's a variety of ways that we can deploy capital to companies. The companies that we don't fund, this is a shorter list than the types of companies we do fund. And unfortunately, so if any of you in the audience are biotech, pharmaceutical type company, drug discovery, drug development, that's not something that we typically focus on, simply because the amounts of capital that it takes to develop those molecules, et cetera, is enormous. And they would chew through our capital very quickly. So again, we're lending at fairly small amounts. Most of these entities will chew through our capital very quickly. Their burn rates exceed what's comfortable for us. So we stay away from finance companies or fintech. We stay away from entertainment, music, TV, movies. E-commerce, typically they're very asset light, so it's something that we don't get into. Large scale energy, again, massive amounts of capital it takes to develop these things. So again, any company with a burn rate that's greater than $200,000 a month will pass on, simply because the prospects for it to chew through our capital and not get to whatever we're bridging it to are way too high, and therefore the risk is too great for us. So that kind of gives you a feel for, who we are, what we do, how we do it. At this point, I'm open to questions. I can give you some examples of some loans that we've made in the past, but what I'd like to do is open it up for questions.
Does anyone have any questions? If you want to unmute yourself, write in the chat box.
And hearing crickets, what I might do is just quickly go through a few examples, just so you can see kind of how we've done things. So we've made bridges to acquisitions. This was a company called Computer Motion. They made surgical robots. And what was going on is that the company was in a huge legal battle with their number one competitor. And what they needed to do is they needed capital to acquire a surety bond to get more legal resources to be able to continue this patent and trademark battle. What we did is we provided them a $2.3 million loan in about 8 days, very quickly, very clean structure. It was a very short-term loan. It was a 6-month duration, 12-month interest, or 12% interest. And then we received some warrants. The security interest that we received was a senior lien on all assets of the company, and that included the intellectual property, which this company had probably 50 or more patents, trademarks that were considerable, copyrights, et cetera. They had real inventory, they had accounts receivable, et cetera. So the asset base was significant. The loan was repaid within 60 days. So although it was a 6-month loan, it was repaid in 60 days. And it was repaid by their competitor that they were in this legal battle with, came in and acquired the company. That company is known as Intuitive Surgical, and if you look them up, their stock price is probably in the $500 or $600 range right now. They're a very successful company that owns basically all the intellectual property for robotic surgeries. And for that warrant that we received at the time that the stock was acquired, and we were able to distribute shares of stock, we distributed about $1 million worth of stock for this $2.3 million loan that we made. But that stock continued to go up higher and higher. And so actually the value of that warrant over time was worth about $40 million for that $2.3 million loan that we made. So it gives you a feel for how a warrant can add tremendous value to the lender and give them an enormous return for the risk that we're taking. And then we've made, again, another company we bridged to profitability. This is a game developer that made casually social games. They were casinos and sports related games. And the company saw that the capital markets, like right now, were very challenging. It was a very difficult time to raise equity. And so the company wanted to just kind of go it alone and get to profitability. And then once they're profitable, then they don't need to raise more money. They might want to, but they wouldn't need to. So we provided them a $600,000, what I would consider a bullet loan. Here's $600,000, pay us off at maturity. It was a 12-month duration loan, 12% interest. And again, we received warrants for the loan that we made. The security, again, we were the senior lender. We were senior on all assets and intellectual property. And the exit, at the end of the day, the loan was repaid in full through the operating cash flows. The company became profitable and was able to pay us off through their operating profits. And then we were able to convert our warrant into equity because the company was being acquired. And those warrants at the end of the day were valued at about $250,000. So again, a $600,000 loan where we made 12% interest on for those 12 months returned us another $250,000 due to the fact that the company had a great exit. So those are a couple of examples of what we do and how we do it. And again, for anybody interested, feel free. I think you've got my contact information. If you feel like it, just reach out, and you got a couple of questions to ask, feel free to do so.
Ahmed is asking, what is the typical interest rate and if there's any penalties for paying early?
Right, good question. So as we go back to the typical pricing, typical interest rates currently are 13 to 16%. They could be higher, they could be lower. But again, we are a non-bank lender, so our cost of capital is greater than the bank's cost of capital. The bank can borrow money from the federal government at 5. And usually what they then do is turn around and put a couple of percentage points on top of that. So banks are lending in call it the 7 or 8% range, maybe a little higher. We're not borrowing from the federal government. We have to have investors provide us capital and put our own money in as well. So interest rates are in the 13 to 15% range. And then the prepayment penalties, what we like to say is that at the end of the day, if you pay us off early, let's say we make a 12-month loan, what we want to do is receive a minimum of let's say 4 or 5 months of interest. And so what we'll say is that, we have a minimum interest payment of, call it, 4 months, 5 months. And so the only penalty, so to speak, for paying off early is to pay some additional interest that wouldn't otherwise be paid. We don't want interest for the full term, which is what a lot of lenders do. But from that perspective, it's very, very minimal from a prepayment penalty.